Hey guys, it's Max. Hey, I had a question yesterday about some option stuff. Okay, I'm talking about these earnings trade strategies. So, to trade these earnings trade strategies, you have to figure out what the market maker expected move is. Where does the market maker expect? Let's look here. So on Monday we have earnings coming up in well, MongoDB. Okay, so okay, so you need to decide how far apart to set the wings of the double diagonal. The idea is to put the wings where you're aiming for the price to be. I'll explain more in a second, but we need to know what the expected move is. So the expected move, you can look in. I showed you a couple ways to do it. I was doing it the other day just within option strap by looking at the probability cone, and where they put the first hash mark, that is basically the same as the market maker expected move. So I was just saving a step. But look, if we're going to do it this way, so these guys have earnings on Monday. You can tell because look at the IV of Monday is 123. Then the week behind it's only a 97. But you can tell the IV's jacked because of earnings, and we're trying to take advantage of that. So then there's a little brown color right here next to the numbers, and it goes from where the price is in both directions to where the expected move is. Expected move on the upside is 390. The expected move on the downside is 290. So we're going between 390 and 290 for this trade. So that's where we want to set our wings. So right here, here's our call wing. We'll set it at 390. We'll set the put wing at 290. And then I have to do some other, there's some other stuff. It's not quite that simple, but basically we want to know where are we aiming for because see, we want the profit. We're trying to create a profit tent. We want the profit tent to be right there. So if it hits the expected move, which is what they expect to do, that's the most likely place for it to go. We want that to be the most amount of money. So sure enough, we would make about $1,700 if it can hit the expected move on the upside. Now, if we use this trade, now on the downside, we could do it on the downside and make about 1,000. Now, something I do sometimes is I'll do that. I'll make it where there's no risk to one side or the other. Okay, so the expected move to the upside, 390, that's still covered. If they blow out the expected move, at least you still make some money. It's a consolation prize. If they hit the down expected move, you make money. The only thing that you can't have is down more than 20%. That's why this is I was calling this a bunt. This is as high percentage of an option trade as I know of. This double diagonal. Look, it's an 89% chance of profit. And you're aiming for the two most likely areas, especially this one on the upside. That's the most likely area. So here, we're going to hit save on this. We're going to call this, just calling it a bunt. So we have two types of earnings trades. I'm not calling it loaded dice anymore. We have the bunt and we have the hit and run. And the hit and run is the one that I've been showing you guys, and that's the one that has unlimited upside, and that's more like the hit and run in baseball. You're going for extra bases. But this one right now we're talking about is the bunt. We're just going for a quick hit, a quick little profit there. All right, so let's go back to editor here. Now let's look at some ones I showed you guys yesterday real quick. I had mentioned Lulu had it's loaded dice, but it's really a hit and run. Well, let's review real quick. It's a four-legged option strategy, but it has unlimited, or has upside to it. It doesn't have a capped upside. So it has a big flat spot in the middle. I show you guys this one all the time, and it has a big buffer. This Lulu would have had to drop more than like 5 or 6% for this to lose money. So that's all we were playing for, is Lulu not to drop 5 or 6%. And if Lulu happens to be up, 10, 15, 20% like it was at 25%, then we stand to profit extra. So that's the hit and run. And I also did a bunt in Lulu, and I got thrown out. I mean, I'm getting thrown out because it's down $200. So this is not successful. This is not successful, but you could see right there, I was aiming for the 380, 375 area, which is where this profit tent is. And we just shot way past it. Then I also had a profit tent on the downside, but we shot way past that too. So that's a loser. They can't all be winners, but that was a bunt that you did not get on base. Now, it doesn't have to work like that. Look at DocuSign. On DocuSign, the bunt and the hit and run worked. The hit and run worked big. It's up like $2,500. It's killing it. But the bunt in DocuSign, they must have hit exactly, let's see, earnings bunt. Well, it's only $66. It's not a lot of money, but it's, oh, that's what happened. They went past the profit tent. It looks like we were aiming for 94, 95. And so let's see. Yeah, we were aiming for this area, and it went all the way past, although there's still some profit in it. 4-legged trade, cost $200 to put on. Max loss is about $50. Max profit, 600. The bunts are cheaper trades to put on too, especially if you have a real expensive stock like Lululemon or a stock that's trading in the 500s or something, or like Alta's trading in the 400s. The other thing is the hit and run is expensive and ties up a lot of money, although it does have all that upside. So here's the bunt. The bunt in in Alta only cost about $700 to put on, whereas the hit and run in Alta was a lot more. Alta bunt, it's in here somewhere. Maybe I didn't do an Alta. Well, here's a load of dice in Lulu, which is trading in the 300s, and it was super expensive to put on. Yeah, it made $2,700. That's great, but it also tied up $2,200. So that's good. It made its money back, but these tie up a lot of money. So if you have a smaller account, the bunt might be the strategy you have to start with, or maybe the only strategy you can do, and that's a shame because the hit and run is really a better strategy. But you can do hit and runs with smaller accounts. You have to do the hit and run in a smaller price stock. So let's find an example of that. And that would be like here's one in Marvel, whatever this is. I think it's a chip company. It's a 3-legged trade. This thing, it only tied up $1,000. Brought in a $200 credit, so you got a fifth of your money back right away. And this thing's up big right now. What was it? Bullish loaded dice. It's up $1,000. So that's the key. You need to find smaller price stocks if you want to try to do the loaded dice trades. Here's an OKTA. It's in the 70s or so. This was a $300 winner. 3-legged trade. Let's see what's going on here. So we were on this trade. You don't really aim for anything. You just want prices as high as possible, but you have a big wide flat spot in the middle that's like an iron condor. This thing I love this trade because it trades like an iron condor, but it's also trades kind of like stock. Let's see here. Well, you just can't see it on here, but you have some unlimited upside over here. Yeah. Okay. So this one right here tied up $1,200, which isn't nothing, but you got $283 of it back right away. like I always say, you could take your wife to dinner that night. I mean, or whatever. You could pay a bill with it. That money is, income. But then you would also, in addition to that, your wife's happy with you. You took her dinner last night. In addition to that, you're cashing this trade in right now for whatever it's up, $700-800. Market's about to close in 30 minutes. These top trades right here don't expire till next week, but anything down here that I've showed you guys it's time to take it off. These all are profits. Even the ones that aren't a profit, don't just let them expire. You have to take them off. You can't just let an option expire when you do these strategies where you have sold options and bought options. You have to actually take them off. And sometimes that involves paying a buck or two to get out of them or something. But that's just kind of the way it goes because you're trying to avoid assignment. If the options that you have are all out of the money, you don't really have to worry about it. But still, to be on the safe side, even if it just costs $1 to get out of an option that you have that you're short, even if you have to pay a little bit to get out of it, I always just go ahead and pay it as opposed to taking the chance and letting it expire at 3 o'clock. Sometimes something crazy happens between 3 and 3:15. The market stops trading at 3, but they don't settle some trades at 3:15. And I've seen horror stories about people losing tons of money between 3 and 3:15. Just close all your trades out. Close all your short option trades out. If you have a long option trade, you can just let it expire. Because if something crazy happens between 3 and 3:15 and you have a long option, then maybe that'll help you out. But if you have a short option and something crazy happens, that's going to come out of your pocket. All right, guys. Well, I'm going to get out of here and let you guys get on with your day. All right. You have a good day.